Hello. Yesterday saw the release of the US Federal Reserve minutes from their 27th of July meeting. What that showed was that policymakers are clearly determined to crush inflation. They're going to push interest rates into restrictive territory until there's clear evidence that inflation is cooling. We're slightly concerned that equity markets may be actually almost willingly deciding to ignore this message. If we look at the US stock market over the past year, in this case, the S&P 500, we can see that it peaked around 3rd of January, and then it fell just over 1,100 points, or sort of 23%, to a low of 3,666 on the 16th of June. And since then, it's recouped just over half of that loss. And as at the close on the 17th of August, it was down 9.5% for the year to date in total return terms. What's behind the rally? Well, I think ultimately it's a belief that either a sharp growth slowdown or quickly falling inflation is going to allow the Fed to stop hiking and, in fact, to begin cutting interest rates in 2023. I have to say, that seems very unlikely. And this is what we're using to demonstrate the expectations for interest rate cuts. The blue line here shows where the market, in this case, the futures market, thought that interest rates would be for the remainder of 2022 and into 2023. The red and orange line shows what the market thinks, or what the market thought as at the 18th of August. And as you can see, the market thinks that rates are going to peak out around 3.7%. In March 2023, before then falling, for the rest of the year. And if you think, the current target rate for the Fed funds is 2.5%. So the market's effectively saying, another 1.25% of interest rate rises, and it's job done. Really? I think that is, unlikely and over optimistic. If we look at what level interest rates have peaked at in previous tightening episodes, in every single case, rates have only stopped rising when they're higher than the CPI inflation rate. So that implies that by March next year, and again, if the implied forecasts of interest rates are correct, inflation must have fallen to at most 3.7%, and it's currently at 8.5%. So is that possible? Well, of course, it's possible, but is it probable? No, we would argue not. We certainly think that equity markets are being over-optimistic in their assessment of interest rates, and therefore we're not chasing the current equity market rally, and we're keeping some powder dry for this moment in time. As ever, I hope these comments are of use, and if we can be of any assistance, please don't hesitate to get in contact. Thank you very much indeed.